Seems to be recording. So welcome everyone. Yeah, go ahead. Everything good?
Yes. Turn off the mic. Okay.
I can mute everyone here and raise your hand or chat in if you want to be unmuted, and I'll handle that. So I actually said welcome to you, but I guess I'm your guest. So thank you for having me. Would be more appropriate. It is October 27th, 2025. Can get a chat or a hand raise for if the screen is showing. Yeah, I think it's not. So let me just do that again. Because when I switched to host, it did not share. You are sharing your screen, it says. So are we good on that? If you don't see my screen, just start. Yeah, we got a thumbs up. Good. All right. So I had a choice in preparing for this. If you've given presentations, I'm sure you know the struggle is you could spend 60% of your time on your thoughts and 40% of your time on making a slide deck. Or in this case, I decided to do more of a 90-10 and do a doc. And I'd be happy to share this doc when we're done. So I'll just share it with whoever's in charge, and that can be distributed. But this is a document style. I have at the beginning here a summary. I'll just read off what we're going to go through and the big ideas and dig into those. But the request specifically came from a YouTube video I put on stickytrades.com, their channel, about a 0 DTE options credit spread. Also, there is context, and I've seen a lot of names. I know there's some people live there, but those online, some names I remember: John Chernicki. I saw Ron Bertino. Let's see who else. Lots of people here I recognize. So when you say we talk about the net zero, that's a blast from my past. I still have one of the workbooks on my bookshelf from doing that and teaching that. But that trade, I stopped trading probably in 2018. And it was a trade that did extremely well in low volatility. But we're going to be talking about why I don't, in a sense, why I don't trade that style anymore. Negative gamma, heavy focus, high leverage, essentially is what that is. And I was able to come out very unscathed and did very well with that. I actually proactively cut my size on that trade, just realizing the tail risk. Actually, I'm going to give credit to Ron Bertino for being one of those that kind of really painted a clear picture of the risks involved in the near the money type spreads on indexes. And so that was one of many kind of bells that were going off as I realized, hey, I've had a great run here on this one strategy with the, historically extended long volatility. Maybe I need to look somewhere else for what's going to really survive and be robust in the future. And that's where I've landed. And I've got great strategies that work year in, year out. Been doing well with, and I'm going to describe some of those things to you and kind of give you a catch up of the last several years. One reason I've been kind of quiet, not done a lot of presentations, is I've just been in the private space, been involved in a couple of startups, been trading on my own, building systems, automation, all that. So just kind of been like in the trenches, not out teaching, but I sold one of the businesses a couple months ago that was taking a lot of the time, and I'm back. So I like to share a lot of what I've been doing over the last few years in trading and automation and systems and automated options trading and things like that. So we'll talk some about those things too. So topics we're going to talk about. I'm gonna try to zoom in even. I think that's all it's going to give me, unless I just kind of do a little pinch zoom here. Nice and big. All right. We're going to talk about losing more often as a strategy. I tend to know that this type of audience likes to win a lot. So I'm going to ask you to think about losing more often strategically so that you can spend more time winning. So we're going to talk about accuracy versus time spent winning. We're going to talk about asymmetric bets and the math behind those. So we're going to talk not just about math, because everyone knows the math on win rate. If you have a certain win rate, then you need a certain profit factor to break even or make money. And that's like kind of basic stuff. But it's really like, why don't we really explore that? And why don't we implement that? And why is it that we keep leaning toward one end of the spectrum with accuracy being the highest desire? Why diversification is actually smart. And some people kind of give it a bad name, but it's actually pretty intelligent to use it. Why most traders don't survive asymmetric trading strategies, which is going to be a psychology discussion. How to add asymmetric trading to intelligently diversify your higher probability efforts. I presume there's a lot of high probability focus in this group, and that's what options normally attracts early on. It's like the ultimate, sales pitch to get somebody interested in options trading, whether it's the broker teaching you or somebody with tools or research or courses or anything like that. It's a very attractive thing to come in and say, hey, you can put this trade on, and if you're wrong, you can still make money. And if you're right, then you make even more, you make it faster. And if you're just kind of like nothing happens and it goes sideways, you still make money then too. Or the ultimate, the iron condor concept, where if it goes up a little, you make money. If it goes down a little, and if it goes nowhere at all, you make the most, and you make it even faster. And you're like, what is happening? It's so exciting. So it brings in that I'm going for the high win rate. Okay. And so I want to encourage you to consider some lower probability stuff that might be the most effective thing to help you survive maybe what could cause you damage otherwise. Kind of a quick synopsis of where I am in my pursuits of intelligent diversification and multiple strategies. I'll share some results as far as models. So all the models, and I have a group that I run, and they come in and we meet every week. And I've been tracking these models. So I build them in front of them. I say, I'm going to build a model, automated options trading model. So I build it, I design it, I explain why I chose it, and then I deploy it, and I'll tweak it. So, and I literally won't touch it until the next week. So I just come back in and say, all right, here's where we are. Here's what's going on. Here's what we need next, or here's what I want to try to play with. Here's some filters. Here's another stock I want to add, etc. So it's all been tracked live, out of sample, in real time, just doing one contract per strategy per symbol in there. But I got some just kind of fun stuff to show you on that. And then an invite to try some free stuff from me. All right, so let's start at the beginning. Lose more often. So I meant to shorten these, but I just wanted to get more screenshots of cool stuff, so I did that instead. But anyway, in school, when you grow up, elementary school, middle, high, etc. But I was really focused in on that early, like when you first understood and realized, like when you saw a 90 or a 95 written at the top of your paper, your homework, your test, your quiz, the paper you wrote, your coloring sheet. I don't even care. Like early on, right? You get a 95%, and then next to that, you get a letter grade, and especially in the younger grades, your teacher then also gives you a smiley face or even a sticker or a star on your paper, and it's ingrained in us that, hey, if I get more of the questions right, I get positive feedback. And because the goal is to not have wrong answers, right? And then conversely, if you bring home a 40%, it's usually written in, red ink. There's an F, at 40, you might even get an F minus. It's not just like you got a 50 or a 55, like, it's really bad. You did real bad. I'm gonna give you an F minus, because you're less than half of them right. And this just ingrains in us, like if I'm not right most of the time, I must be doing something wrong. So it's wired in us to have this desire to have a high percentage of decisions that we make to be quote unquote right. And so also just being wrong in general just hurts, right? If we say, like, I don't think it's going to rain tomorrow, and then it rains really hard. It's like, oh man, you just like, man, I sounded like an idiot, about that. Or if you just are like boldly like certain about who's going to win a game or what's going to happen next or anything like that, or what you think the outcome, or we were watching football, got little kids sitting there, or like, you're just so certain when the coach challenges the play, or there's a penalty or something and they're reviewing it. And you're like, oh, he's got that. He got that so obvious. And then they come back and say, nope, it's the opposite of what you thought. And you're like, oh, okay, whatever. It's just like, it hurts a little bit to be wrong. But that whole concept of like desiring to be accurate and right all the time is completely backwards when it comes to the most competitive and rewarding fields in life. Okay. And I'm going to start off with a silly one. And the silly one would be dating. Okay. One quote I heard once, very funny, and I enjoyed it. It's like when young men are, going out together to, hit the town, and there's ladies around, and they're like, they see, a guy sees absolutely most beautiful girl he's ever seen in his life, across the room. He's like, she is so out of my league. And the one guy says to him, says, you know, she might say yes. She probably won't, but she might. And you're only going to get a chance if you ask, right? So that would be one where you're probably not going to get it, but the reward could be worth the effort and the risk, right? I actually forgot, if anybody knows this, I'm not a baseball guy. I forgot to fill in this blank, but what's a good batting average, right? Isn't it like less than 30%, less than 40% at least? I don't even know. But it's low. Or the percent at bats, like how many times you strike out for every time you get on base, right? It's a low probability thing. And here's one more getting into like trading stats, more directly related or parallel to trading, would be another like sports metaphor or sports comparison, is NFL passing plays have a 53% win rate, more or less, okay, with a 7-yard average gain. All right. And running, or carrying as they call it, because whatever, yards after carry or whatever. So running with the ball has a 73% win rate with an average of 4.4 yards. So there's the attraction to, well, I like the higher win rate. I want to have a more opportunity to get the yards, but the other one has more yard potential. There is also beyond that the strategy, which does carry into trading as well. You say, well, whichever one nets the most is what I should do. Well, the reality is the team will adapt to you at some point. Strategically, you must be diversified in what you do. So the question becomes, would you rather have 53% of 7 yards or 73% of 4.4? And initially you're like, well, hold on, which one's which, and it's not terribly different, but the passing at the lower percentage nets more yards. And it's also more fun to watch when you're playing the game. But like we just said, it's also, there's a strategy too. If you do all of one, then you'll be found out and you'll get stuck and that won't work anymore. So diversification matters there too. So the point is, are you focused on win rate at the cost of earning more profit and also earning more consistently over time in different market conditions? Because these high probability strategies can come with the tail risk and also not work in many different environments. So my most consistently profitable strategies right now are less than 50% accurate. Across the board, I actually am around a little over 50% all in across the board. But the most consistently profitable, now consistently profitable, you say, well, it's less than 50%. How is it consistent? Well, that's when we start to talk about time, actually like calendar time. So more months, more years, year in, year out, more consistently profitable has less than 50% hit rate on trades. And my most profitable strategies are less than 40%. So as the win rate drops, the excitement factor and the potential and the growth rate over years goes up in those. And the strategies with win rates above 70% are the ones that have actually caused me the most stress and pain and sleepless nights, and just holding danger, and having those sudden and very terrible experiences, where the lower the probability is, that I've set more and more year in, year out, as I keep moving through and just saying, I like this one. I like this one. They just have those lower probability asymmetric bets, wind up doing better year after year. It's not 40% of years, it's 40% of trades. And we're going to talk more about how that pans out and why that is the way it is. So if any of that resonates, then you're on with me. Otherwise, we'll just keep going and talk about it some more, make it clear with some numbers. So let's talk about more. So spend more time winning. So I just asked you to consider losing more often. So now we're talking about how you can spend more time winning and why these are two sides of the same coin. A 40% win rate can win 70% of the time. Okay. 40% win rates can win 70% of the time. So to say, like, what do you mean? Well, I have to ask the question and we have to answer, what is time? Okay. This is not like a metaphysical, philosophical conversation. I mean, the most basic, like third grade level, maybe even first grade level. What is time? Well, is it your attempts? Because people say this trade wins 80% of the time. That's the quote. That's what I hear all the time. This one wins 80% of the time. This setup has a 70% win rate, or 70% of trades win, or 70% of the time. Well, I don't think you're using the word time correctly, because it's semantically or culturally acceptable, but it's also confusing a very important factor of, well, how much time are you spent winning? Let's check the chat, make sure we're on the same page here. I'll answer that right now, Dave. So higher win rate normally has more tail risk. So you normally have the, and I'll have a chart here in a moment, more of a table actually, where let's say a 90% win rate options trade. Just think about that. Normally, what's the held risk compared to the max potential reward? And so it's the idea, like, you're waiting and waiting. You're like, I'm just nine. I just need 9 out of 10 to work, and I hope that 1 out of 10 ain't as bad as it could be. And the really comes down to, well, it's out of the 100. So making sure you cover that. So not just, hey, I did 10 trades and I had a loss. It looks like I can scale up because the loss wasn't that bad. How bad can the loss get? And how many of them can you experience before you get to a new high, and how deep can you really go? So just knowing that like was always in the background, there was always that monster hiding around the corner of, what happens when we do gap down 10% when I'm in this trade and the volatility was low at the start of the trade. So yeah, exactly. Brandon's just saying most basic one, selling naked puts, would be a perfect one, or the worst of them all would be naked calls on equities, individual stocks. Then you get a takeover bid or, product announcement, something like that. So it wasn't pricing in more than 5% move and it's up 25 overnight. You just learned what that 1 out of 100 can do to you. So just kind of stepping away from that. So not time, but not attempts, but minutes, days, and months. And I have TradeStation open. It'll be a good one. If we have time, I want to click through those and actually show you. So I'm going to talk fast, so hopefully we can get to that. Where I'll actually bring up back tests, and I'll bring up strategies and their historic runs and show you, like, here's 38% win rate and here's time spent winning. And, here's, periods of time underwater, et cetera. So I once dug in, I won't say names, I just think it's appropriate, but there was a service, we'll call it, out there teaching or giving away, or I don't know what you say, options trading strategies. And they claim they had this, and I'm just picking a number because they changed. It was over time, 99.3 one year and 99.8 one year, et cetera. Anyways, they claim to have over 99% win rate options trading strategies that you could follow along. And it was a little pricey, and I didn't believe it. And I'm not a big fan of super, super high win rate targets because I just don't think it makes any sense. I don't see the purpose in it. So I never did it, but I did finally meet somebody who was in it. And I said, tell me how it works. What in the world are they doing and how does it work? And they said, well, all they do is they just keep rolling the trade until it wins. Then they say it's closed. I said, are you absolutely kidding me? So I said, so are the trades like underwater? Oh, he's like, oh yeah, the trades will be underwater for months. What? So they'll put a trade on, the market will go hard against them. They'll have to roll at a loss, AKA add money to the trade when you do that. So they're rolling at a loss. They're moving through, they're just rolling and rolling and rolling, adding trades, adding complexity, adding transaction costs, doing all these things. And they're down for months and months and months. And they finally do a series of rolls. Okay, what is a roll? A roll is a trade. Okay. If you close something and open something else, you closed a trade and you open another trade. Like, let's stop uh, painting lipstick on a pig here. So they close the trade and open another one, but we're going to market a roll so that we technically did not close this quote unquote campaign. And so we're going to be down for months and months on end, climb back, take it out, and then go send a, a marketing email out saying we got another win, 99.4% now. Yuck. That's just garbage. Okay. That's not winning 99.3% of the time. That was losing 80% of the time and climbing back and barely eking out a profit at the end. Okay. I'm talking about time. And as I've lowered my accuracy rate, I'm winning more of the time. Okay. It's pretty wild. So that's that. So let's look at some real strategies. Hey, this is it. I actually, right? Yes, I marked off time to do it. So let's do it. I'm telling you, I try to put a lot of thought into this for you. All right, so let me bring this over. Got a weird monitor, like one's different resolution than the other. Okay. Anyone, this would be annoying. I hope this works. I had to reinstall it. I'm not really using TradeStation much. Don't break on me. Oh, I think I know. Ads, strategy. I think it's called something else now. I had to reinstall it. Let's see. That'll be sand. I have another way to look at it. Do I know what error am I missing here? I think I have not enough data. That's what's going on. It should have told me that. Yeah, that's what I thought. It just didn't I didn't see it. So I had to reinstall, like I just said. Yeah, well. Which one? PM. See, that was down here. I had it working earlier after I reinstalled it. Let me, I'm online. Let me do this. I'm gonna see if it's rendered. Yeah. There we go. Nope, that's an old trade. That's all that is. Well, that's really annoying. Let me just kill this one, give a new one. That's wild. It was doing that. Let's go with, let me just try a different one. Wow, that's really sad. So where's another way I can find this? I have some custom code here. All right, I can do it that way. Hmm. We'll just come back to it. It'll be in the back of my mind to get to it. Where have I think I have a YouTube video. YouTube on slime. No, that's not there either. So we'll just proceed without that, but I have other strategies I can show you. All right, asymmetric bets. So where most traders aim is this blue area, right? So this is your win rates across the top. So if you have 10% win rate, there is no scenario where you have to have you have to be right more. You break even at 1 out of 10 or 1 to 9 risk reward ratio. Reward on risk, I should say. So if you make 1 and you lose 9, then you break even. So 20, that's the 1 to 5. And then at 90%, is this the, oh, I have it reversed. That's why I was like, why does that sound backwards? Okay. So at 90% win rate, if you can risk 8 and make 1, and you can still be profitable, right? So you're like, well, that's great. I can, as long as I just get that right, then I can be profitable. So the attention often goes, that I've found, especially in the options world, is like to hover over here as far as we can. 70, 80, 90% win rate. And then these strategies where I'm going to just take some profit off the table. Yeah, Ron, I tried that. I just think there's something else broken on it. Because I even put a different strategy on that doesn't need that much. And that's where they focus. So then there's like the fantasy, right? So they fantasize, well, if I could have the 80, 90% win rate and get more of these trades, right? And I've pegged one time I pegged a butterfly, pegged the top of the butterfly on one trade. It was pretty small. I don't care. I put it on and I let that thing ride, and it pinned the top. Like within like invisibly, you couldn't even see the difference. So one time I got that. All right. So we just kind of like, man, could you just imagine if I could have awesome risk reward and high win rate? So they fantasize. So they like spend their time content over here. Most of my trades win. The return on risk is not that great. If I could just increase the return on risk. But then they like ignore this area. They ignore the 50, 40, 30, 20% win rates, because they say, well, I don't know how to set my stops and limits, or I don't know how to get that skew in my favor, knowing what I know. Well, I'm going to give you some strategies and some information that maybe will get you toward that. So why do they ignore them? Well, the first point was it's psychological miswiring to desire high accuracy, especially because they're not understanding the difference between accuracy and time spent winning, which I wish I could show you. It's very annoying. Just looking at it again, refreshing my memory now. So, are you saying like, let's see. Let me just add enough. Yeah, nope, daily. It would be very powerful to be able to see this. Errors? Good. Well, tell me the error. Error calculating. That's super weird. It's very annoying. So you could switch. So are you saying, Andrew, so you're saying I should just switch from high win rate, high accuracy to low win rate, right? Is that what you're telling me to do? Absolutely not. That's not what I'm saying. I'm saying to add it. So mix it in, add it. Where I found a big breakthrough in performance and consistency in trading was when I stopped. And if you watched me years ago and I worked on net zero, I would do hundreds of studies and back tests on little tweaks on the net zero. And it would be like, let's slide this one delta this way. Let's try 10 days further out. Let's do a time-based cutoff here. And I spent all this time trying to like squeeze more blood out of that stone. And when I kind of realized, you know what I'm really trying to do? I'm trying to make 30 to 50% a year out of a market that averages 8 to 10% ish, depending on what period you're looking at, return for the people who invest in it, and doesn't even have volatility that high. And the only way you get 30 to 50% return out of a very high, a low beta market is through lots and lots of leverage. Okay. And it doesn't mean they're all wrong, but I could not keep going deeper and deeper and deeper into that and think that I was increasing my margin of safety and increasing my survivability. Okay. So I said, all right, let me just back that off and cut the size down. And I'm just going to dive right back into and figure out all new strategies and all new approaches. And I knew enough people and I had enough desire to do it that I did it. And it's worked out very well. So I'm going to give you a couple. First one's going to be the options trade you asked for. So here's an example of the mentality of I reduced the probability of the trade working in order to get the result I wanted. Okay. So this strategy that I was asked to come here, share with you, there is a YouTube video, you can find it, get more detail on that. I'm going to give you the rules right now, tell you a little bit about why it is the way it is and how it works. But the way I got to it was by intentionally reducing the win rate in order to make it have a higher survivability. Okay, so this trade is a 0 DTE put credit spread. I'm not an active screen day trader. This is automated. So I presently use Option Alpha for automation, but I'm building my own right now. And then that will, after I am very, very, very comfortable with using it and I talk to good insurance companies, then I will make it available to others. But right now I'm just building it for myself. But Option Alpha is effective for this. They have limitations, they don't have a ton of stocks. There's a lot of stocks they don't have, I should say. And some other logic issues. You can't use code and stuff. You just got to use, what they have available. But this is one you can do. So 0 DTE on Qs, by the way. 40 delta short, put credit spread, 10 delta long, 15 minutes after the open. No real specific reason for that. I think that mattered a lot more a while ago, years ago, decades ago even. I think you can kind of hit it pretty quick, especially equities, tight spreads. But I just did it that way because it was one of the options, and that's the data I have. So I'm just sharing what actually is tested here. So 15 minutes after the open, 95% profit target of credit and an 80% stop loss. And so you can see right there, I'm putting the skewness, I'm skewing it toward a slightly more profitable win and a slightly smaller loss. As well, there can be slippage and you can lose a little bit more, but there is no overnight because it's a 0 DTE, it's the day of. So I'll be out by the end of the day. And then it's an exit 5 minutes before the close. And this is not hypothetical. I'm sorry, you're never supposed to say that. So I'm going to take that back. All of this is hypothetical and not recommendations. But I'm saying that I do execute this trade. And yes, it does work. And you can get out 5 minutes before the close with automation or doing it manually. So this is just a quick comparison of the performance. So it's the put credit spread in green is the yield, and the Qs are in blue. And so the Q is just held. So it's just like saying like if you just bought and if you just held it over the same period of time, just own it at the open and sell it at the close day by day. This is what you get. Actually, I don't even know. I think it's just day by day. It's what I have. I did not do like an open and close thing. I think it was January something I did this. So I'll have to double check that. But you can see pretty smooth equity curve. And if you look at that equity curve, you might think a put credit spread very close to expiration, maybe something comes in your mind on a win rate. Like how many of those trades appear to be profitable? Like 80, 90, maybe 70. Okay. The reality is it's a lot less. All right. So the ingredients, it's 54. I'll just tell you that. So we're not thinking about that. I want to talk about this right here. Ingredients of this strategy. This strategy, so you think about like I'm baking a cake. All right. This is what I'm throwing into the strategy and why it works. It's positive theta, credit spread, which generally has higher probability. You could say just based on the strike price, some people would say it has a 60% chance of expiring worthless. I think it's on the put side a little higher than that. So maybe it's more like 65, 70. I do have reason to exit. I'm not using options as a structure and assuming the options market's just there to pay me. I have a reason to get out that is a lot less than, not a lot less, I'm sorry, it's a lot less than the max risk, but it's less than the max profit. So the ingredient I'm adding is asymmetric P&L, where I'm aiming for higher profits and lower and smaller losses. Okay, so the series of trades are smaller loss, and yeah, this is with Q's options. because now there's no commissions and automation. I just want really good tight spreads and execution. So I use the queues for this, and it's a nice wide spread, so it works out fine. And yeah, you can get zero commission or really low commissions in a lot of places now. Back when it was a lot higher commissions and a lot lower underlying, it didn't make any sense. But with automation, with lower commissions and a higher underlying, now the queues, where are we at? 628. I mean, I was trading the rut index options when the rut was 600 and something, and it was an index, so now the ETFs are priced like what indexes used to be. So the slippage and all that, it just works. No overnight gaps is an ingredient. So I'm handling that element of options. I'm kind of removing that component that causes problems. And I'm using leverage, okay? Because I wouldn't take these trades necessarily. If you think of the nominal position size, so each option is 100 shares, I would not multiply the number of contracts times 100 and then buy that much size in stock, for day trades. I wouldn't do it. But I can gain that exposure through options, and with the defined risk of the spread and a reason to exit and not having gaps, I'm able to use some leverage. All right, quite a bit, as much as I need to. I mean, especially the nominal exposure at the short strike compared to the amount of margin being used, like it's astronomical if you really think about it. Like the amount of the market you're controlling for a short distance between those two strikes, there's a lot of power there. It's pretty phenomenal. To really think what's available to us with just like a few clicks. If you compare, like I'm involved with a real estate private equity firm right now. I'm just like, you guys, like I'm doing market stuff for them, analytics and data and talking to investors. And like, I just hear about what they do. I'm like, the amount of work they have to go through to like get leverage is just like unbelievable. Like every single deal has to have underwriting and takes weeks of individuals and all these expenses. I'm like, man, I can buy an at the money call and like the amount of money and the amount of exposure I get with like 2 clicks is just outstanding. Like I love it. I absolutely love it. Outcome, I have more time spent winning on while reducing the win rate. And that's the comparative to the test without these other elements added. More total return. And so it drops to 54% versus I estimate a 70% win rate if just the raw trade, if you just put it on and close it. But I think that you would lose more of the time. You would have more time spent in a drawdown, and you would have a wilder ride than if you just lower the win rate. Can be traded manually with not a lot of time, because you just enter. If you're not familiar, you can set conditional OCO, enter a trade, put a stop and limit, and send it all at once in Thinkorswim and most other places. But Thinkorswim is very easy to do it. If you've done it with stock, you can do it with a spread too. So you just create an OCO ticket. I think I opened this just in case. So I just have this. So you can do first triggers OCO, and you just create opposite order. So this will be the conditional, and you say like, I'm just making up numbers here, an $11 stop. Okay, so if it gets to 11, it's going to send that. And I have an OCO, so I can do another one. I'm going to duplicate this one. I'm going to make this my limit. I'll make it 14. Okay, and I'm going to call it a limit. Okay, now that's with a single strike, but you can do the same thing with the vertical. You create a vertical, switch this, drop down to OCO, and then you can create the opposite orders, and it will place those. And if your stop gets hit, it'll cancel your limit. If your limit gets hit, it'll cancel your stop. So you can do it manually, and it can be automated. The easiest place, in my opinion, is Option Alpha right now. I don't get a commission for that, but I hope you enjoy it. I have a username. You can clone my strategies there too. You have to send me an email because it's like really long username. And it's hard to break. When I say hard to break, it's robust, like a robust piece of equipment, you know. Um, it's tough, it's strong, right? Side note, that video on YouTube was released, I don't know, January, February, March, somewhere in there. I can't remember, 10 months ago. And so it actually has a new high P&L since then out of sample. So the strategy continues to work. Had a little drawdown, but it's back to a new high P&L right now, obviously, because the Qs are doing great. But it has continued to survive fine. So diversification is actually a smart move. Buffett said, you know, is known for saying something that kind of irritates me. I think you know, who can't admire Warren Buffett, right? But there's one thing, if I could sit down and talk to him, I would say, Uncle Warren, I have one question about your thoughts on diversification. You know, he kind of teases diversification as protection against ignorance is the phrase. Like, oh, diversification, that's just protection against ignorance. And I say, but why do you, and he says, I just own one stock, Berkshire Hathaway. That's not true. That's not true. You control the company and you own hundreds of companies. Okay. So Mr. Uncle Warren believes in diversification, whether or not he says he does out loud. Okay. Now it is true that you know, without another strategy, yeah, diversification is just protection. But here's my claim is perhaps we all just need to recognize that we are just all ignorant when it comes to the future. We don't know the future. Okay. We don't know what's going to work, what's not going to work. So let's just embrace that. Okay. Diversification. So if you got one core strategy and that's what you do not get rid of it. You know, say like, oh, I heard high probability is a bad idea. That's not true. Only high probability and trying to scale it with more and more assets and only reinvesting into that one thing, that would be my concern. Okay. There are absolutely high probability strategies and trades that are worth trading. But you know, if you're going to only spend your time going deeper and deeper into those, you could just make everything could be rhyming and everything could get slammed at the same time. You're just overfitting that one thing. So I claim and I believe that intelligent and strategic diversification is different than just buying everything to avoid being wrong on one thing. So the opposite of diversification would be focus. So just, hey, you know, just focus on one thing and become an expert in that one thing, you know, or you only need a few things or something like that, like not diversifying. So it's different than that when you're intelligent and strategic about it. Okay. So I'm going to talk about diversification in only one element that I think resonates with this group, and that's the landscape of accuracy versus the win-loss ratio. So if you think about, because we could talk about indexes versus stocks versus crypto versus buy and hold, all these things, I'm just going to talk about win rate only. As you think about, hey, maybe if I start to re-explore or try these systematic rule-based or largely rule-based trading approaches that aren't aiming higher and higher win rates, what could they be? You know, and then how do they work and how would they fit in? So if we think all the way at one end, you know, the risk-free rate of return, whether that's treasuries or government-backed CDs, money markets, etc. You know, you have a 99.9999%, nearly 100, you know, as close as you call is risk-free of making something, you know, so your break even, I don't know if I have the decimals right here, but the idea is that your break even's pretty low. Okay. Your break even is the inverse basically of, you know, in some way of the interest rate you get. So right now you can get a lot better than a fraction of nothing. To do well on that, you actually get something these days, which is kind of fun. That was a long time that we didn't. And credit spreads, you know, it's 80%. So you need the win-loss ratio, 0.25 to 1 at 80%, et cetera, et cetera. So, but these are the, I'll just focus on like, these are the types of approaches you can take and get into. And then I'm going to give you access to one of these that I like a lot. This is why I spend most of my time right now, adding more things to this and doing that. So as we kind of dive down, so credit spreads can be that, iron condors can be that. Iron condors are just two credit spread trades going on at once, especially if you adjust them independently. Then you're just trading two credit spreads strategies, you know, at the same time. It's just paired credit spread. If you're not closing the iron condor always in one single execution and you're independently moving the sides, you can just start to think of it as two different trades. Maybe even put them in different expirations when you roll them. So mean reversion tends to be in that 65% win rate. So that's when you're below moving average, you're below VWAP, you're at the bottom end of a Donchian or Bollinger Band, etc. Okay, and you're looking for that movement, not all the way back to the other end of the range, but back to the middle. Whatever you define as middle and whatever you define as bottom or top, generally speaking, and that's where I'm really annoyed TradeStation's not working, because I could show you this over and over again. I would maybe I'll come back and we'll do this after I get it working again, or I'll just get my software fully up and running, where I can show you that you give me any ticker and any mean reversion indicator, and we will be somewhere, this will be kind of the average. If we look at 10 or 20 different things, you'll be around here. So if you say, you know, pull up the Qs and use Donchian channel, pull up the Qs and use Bollinger Band, pull up the Qs and say, if it's below linear regression by come back to the middle. You're going to be now your returns are going to be wildly different. Some will lose money, but the percent of winning trades will be about that. You can get into momentum scalping. So that's where you're buying high, selling higher, but not on like a big swing, just a quick scalp. Not a like really quick, but like a one-to-one type thing. And then momentum swing trading is the reason I did it is because it was so contrary to the income, like perfectly balanced in that lower win rate. The reasons it wins is for very different reasons. Okay. So the types of market conditions where those are very, very, very profitable are when market neutral or negative gamma options trades tend to struggle. So it's like, well, maybe so I jumped right down there and added that, and I didn't really have to go anywhere else. I just added a whole bunch of things to that, and I put these two together, and it's a smooth, nice ride. And then I'm going to be adding these other things too, but I just haven't had to do them yet. And then you get like the trying to hit the home run thing. So it's like, I'm going to buy right here. You know, if it breaks this level, I'm going to buy. I'm going to set my stop right below it, and I'm never selling it again. Okay. Or I think this thing's hit the bottom and it's going to turn around and go make all-time new highs, and you buy out of money calls, right? So that's where your win rate's going to be very low on those attempts, but you have, you know, nearly limitless potential. So what did I want to, I'm going to make sure I don't miss anything. I'll just go super fast through the psychological part. Why most traders don't survive swing trading strategies. Low win rate is demoralizing without context. So if you don't know time spent winning and you don't, where's one I could show you? I can't bring it up. It's really irritating. So the context being, I show you, where's that one? Here's the context. Here is one. I have one. Okay. So here to here is a small win and two losses, right? So if you like trade, you know, like, and you're used to like, I want most of my trades to win, and you're here and you go, okay, small win, loss, loss. Some traders are done at that moment. And it's just wild to me, like two losses in a row and they're out. Like, okay, well, I got bad news for you if you want to be a swing trader. Like it's going to be two or three for every one. And I say that because some of them are such small winners, like the time spent dealing with it wasn't worth it. So you have like a really small win, two losses, and then a big win. You know, like 25%. Well, yeah, that's a season. You know, a season of that trade could be like that. And then you could have 2 or 3 wins in a row sometimes, but you're going to have those periods of time where you're going to just take a bunch of small losses. So that's going to be, oh, we're way down there now. Okay. Yeah, so the context is the history of the strategy, how the market behaved in the past when it was calm and quiet. I do have one, I just remembered. I have a, like, I actually am making this video thing. Did I leave it up? I did. That's fun. So this is not a great example, but I'm actually making this like video playback of strategies. Let me just hit refresh and see if it works. Yeah, so what it does, it plays back the strategy. So this is a really, RGTI is like crazy volatile. But this one was like, up until this last win, it's really, really volatile. So it's like, it was up like 180%, like on one trade there. It ended up at, actually, no, I'm sorry, it was up a lot more than that. A lot more because it was down a lot prior to that. So this is what I'm talking about. The context of, let me see. Yeah, so right back here, the context is it did this once, okay? And you'll just have to trust me, I guess. Like I saw this, I was not a part of this, okay? But I have scans that show me stocks that do stuff like this. When I say stuff like this, go from 2 to 20. I say like anything that's moved a lot back, over the last year and is in any of these sectors, and I'm going to give you the list of sectors here in a minute. I want to trade them. And let me tell you, it got chopped up. It was getting chopped up and it was losing. And I I didn't actually get involved until maybe around here. So I got involved somewhere in here and I was like, these are all losses. You can't really see it. Let me see if I can zoom in a little bit. A little bit. It's trying to. Okay. So this was, and it's not using this average, that's just on there. So it bought here and sold down here. Then it bought here, the top of that bar, and sold here. Then it bought this and then it sold there. And then it bought here and then it sold there. So 1, 2, 3, let's see, that's not a lot. 1, 2, 3, 4 losses in a row. Okay. And you're like, what am I doing? I guess it's, this isn't for me. Here was a win, buy here, sell here. Okay. Buy here, sell here is a loss because you buy here, sell here at the close. So that's a loss. Buy here, sell here is a small loss. Okay. And then boom. Oh, that's not, yeah, that was it, right? You ride from the 16 to 58. Okay. And you can't, if you don't have the context of what's possible, which is 10x return, 1,000% is possible, and it's in the quantum computing space, then you won't make it through this to get to that. And that's why I like automation. So at least I had one example hiding somewhere. Another one, why most traders don't survive trying to get into swing trading is they try to swing trade in the middle of a move. So they hear about something going on, like RGTI, I guess. We'll just, since it's our only example, we'll go with that. It's like, hey, it's popping up here. And so they're trying to like catch moves in here. Now this one gave you so much it's possible. But if you're trying after this move started, now you're just adding to your risk on each trade and you're trying to swing trade in the middle of this move. The point at which you got in is not favorable. So when I say the middle of the move, like it's because it's already going on and you're trying to jump into something that's already working rather than it worked before and it hasn't been working lately. Now I want to get in and use systems to just ride out the chop until it's time. And those are very small losses compared to the wins. All right, that's the idea. Trying to swing trade ETFs, huge one, big takeaway. If you're like, yeah, I get it. I'm going to start doing some of these lower probability swing trades. And you're like, so the first thing you do is pull up Qs or SPY or E-minis and start looking for swing trades. It doesn't work. Okay. The market has to be very volatile to have a chance. And the best way to explain it is, the market nets on average annually, let's call it 9%. Okay. Maybe a little higher than that these days, historically long term. 9%. So you're like trying to find the move. I know, yes, but it goes up 30 and down 20. And there's a reason why, net's 9, but there's the big swings in the middle, right? Yeah, but don't you think there's money to be made, more money to be made in things that can move and tend to move 30 or 50% a year net, or at least double the market? That's what beta is, that relative volatility, the relative growth rate, technically, but relative volatility is really the way to look at it. So how to add it, all right? So I'm going to give you my list of stocks. It's not my entire list, but it's my favorite list of stocks. I call it Next Wave. Let's see if I can find it. Okay. So if you go, I have to log in again. So if you go to edgenavigator.com, you can read about it. So example, here's, some data here. So this watch list, if you bought and held, which is a giant if you just happened to pick this list that many years ago, that's a huge if. The idea is not, hey, you could have made this money. The idea is this is how much more these stocks move. These stocks move that much more. The S&P 500 baseline is this nearly flat white line underneath, okay? And this is how much these stocks move. And they look how much more they go down too, right? So they're very, very volatile. They're in growth sectors. That's what it looks like. So, I can't remember what's on there. Let me just log in again. At least my stuff's working. It's TradeStation not working. So Next Wave watch list. It's updated monthly right now. I'm actually in the next few weeks going to switch it where it updates daily to give you the position, how much where it is right now. But right now it's just giving kind of a monthly scoreboard of these stocks. So it's the themes. It's all these themes. So like game-changing concepts in the world that are going on, where they are, kind of a heat map on there. And then as of the end of the month, where it is on trend and price action. So looking for things that are, moving at the moment. So what's cool is we are near the end of the month, and you can see that some of these things, like RGTI, BE, this was almost a month ago. These were scoring high and they followed through. And then some of these also continue to underperform. Now, some of these had pullbacks too, and that's where the signals come in. So this is just the watch list. It's completely free. You never have to pay for it. And then you get that. So it's the high beta. So do not swing trade ETFs and low beta stocks, things that don't move very much. The risk reward is not, if you're right 1 out of 4 times or 1 out of 3.5 times, the wins aren't big enough. They just aren't. It's not a very good ride. So trading a bunch of stocks buried in an ETF is very different than trading a bunch of stocks, especially when they're high beta. Okay. And then you can check the stats and decide what's appropriate. I'll show you that next. There's a 7-day free trial for everyone, and I'm going to give you guys, I think it's a big discount. I'll show that in a second. So here, when you get in, you just click on the daily. And so this pops up every day. So this is actually the signals I was trying to make work in TradeStation, which was not working. They're all on here. So there's I think it's 89 stocks total. Well, I guess here's 67 open. So most of them are open. It was 89. There have been 50 exits. So it's not that there's 50 flat. I'm sorry, 55 exits over the last 2 weeks and 50 entries over the last 2 weeks. Average open P&L is 14%. And so here's like BE is a top one. Now don't look and say like, oh, that one's doing the best, let me go buy it. The idea is, and I have it in small print here, let your winners run. Just something that will get embedded into your brain after a while if you do this. Swing trading, just you're gonna have a lot of stocks like gold did recently, like RGTI. You're gonna have a lot of stuff where you're up a bunch and then you have some give back. But there's gonna be a lot of times like this where here's where you thought you were up a bunch, and then this is where it went. That's where it finally got you out. Okay. And this is daily. I do hourly in most of these. So you get out a little faster. I actually got out once and then got out again up here. But the daily, like, is that a lot? Is that enough to take it off? Or is that enough? Is that enough? So you just go in that last swing, if it had repeated that again, you would have been like at 130 before it turned back down. So you just gotta let the winners run. So these are the top winners. This is all open signals. And then what you do, and I'm going to add a search tool for this, you just type the date of the last market close. I don't know if we have any. Yeah, it's got today. So like here's today's trades. So Riot got in today. Tesla got in today. Space, sorry, I don't know why I said that. First Solar, etc. Okay, so you just search for the date. I'm going to have a search tool for that. But these are all today's entries, and you can see that's why they're all low P&L on there. And these are so the losses. Let's talk about asymmetry, and also talk about time spent winning versus losing. If you look at the held positions, so like look at all the greens, right? And the market's not super strong, but there's a lot more green than there are red, right? Because I'm holding them for a very long time. My chart, my screen, my radar, as far as like my positions held, is almost always a bunch of greens, and some of them are very large, and a couple of reds that are very small and will probably be closed soon. It's always that asymmetry playing out over time. I'm just constantly staring at larger open P&Ls. I don't feel like I'm losing 65% of the time. I feel like I'm winning 80% of the time. So it's a very important shift in psychology and in strategy to consider that. Here's some closed ones. RGTI closeout 150, Quantum 100, PUT, blah, blah, blah. So those are all exits. And then you can see the losses down here. There's plenty of losses too, but they're all relatively small. Here's one moderately large one. But if you like average out, you look at the number of them and the size of them, the skewness is there. How many? 1, 2, 3, 4, 5, 6 that are larger, not only larger, but up to 7 times larger, 6 times larger in size. Okay. So here's how you get this, because you're good hosts and brought me in. So I'll just tell you my story another time. That's that. Oh, here's the I have no way for you to get this right now. Actually, yeah, you can go to stickytrades.com and join this group, but you might feel lost getting into it. But this is some of the stats of the ones I built for a group of traders. I built these out week by week since May, and you can see there's not a lot of trades early on. Then there's more and more trades going on. So I just do I model it at one contract per strategy. But there's 340 trades. 51.5% win rate, because there are a lot of credit spreads, but there's also a lot of long calls and some equities in there. But it nets out to around 50% in this world with a lot of income stuff mixed in. Profit factor 1.76. So if you see just over 50-50 win rate, and that profit factor, all you got to be is 1.01, to be theoretically profitable. So 1.76, Sortino 2.8, et cetera, et cetera. Okay, so that's some stuff I got going on. If anything, it's just say, I'm really tracking stuff. I'm really trying my best in doing this, not just theory stuff. All right, here it is. So you can get the daily signals 7 days free no matter what. Then this code will I'll give you 20% off. And I think I don't remember what the price is. I have to go in and let me just do this. So you go in here, put your email in, And then on the next page is where you put your code in. But I want you to read all this and see. So like you got the symbol list, right? Now you need the signals, and here's why. Buy and hold, these are your drawdowns, your potential drawdowns. Okay. These are some of the worst drawdowns in some of these big stocks. This is the equity curve of the signals on the stocks, has a max drawdown of 8.7%. Okay. Trading the same things that were down 60, 67, 84, 89, 90%. Through signals and diversification, we get it down to less than 9% drawdown. So that's great. So if you come in here, do all this, and you do, what did I do? I did Raleigh-Durham, RADU 25. So it's already $0, okay, for 7 days. RADU 25, apply. And what that's going to do, you can't see it there, but it's going to take this $29 rate, it takes 20% off for a year. So it'll take you to whatever that is. $6 less. Okay, 23 bucks. All right. So 23 bucks, but you get hop in there, see what it looks like for a week, give it a try. So it's RADU like Raleigh-Durham, 25 like the year. And I'd like to have you in there. Okay. This strategy I've been trading for. I've traded a variation of it now for about 8 years, in this exact set of rules on these stocks. Many of these stocks, I've been adding some over time, in full autopilot for 2 years straight on this exact set of rules. One that was about 90% the same for about 8 years. So this is great stuff, pairs very well with market neutral type things. Really only covers the upside, except for the fact you go flat and you stay out during big bear markets. So just diverting into this and going flat on some of your stuff is another way of reducing your downside risk in there. So I'll wrap it up there. We can do questions, or it's up to you on what your normal schedule is. You can chat in and chat in questions, kick me out, whatever you want to do. Who else is in here that I know? Jeff Thompson, I know. I don't know well, but I remember you, Jeff. Ron, I'm humbled to have you ask me questions. You are an expert. People don't know Ron, get to know Ron. So not all of them are good options markets. So stock I'm doing most of my automation stock, and then I go through option alpha and just see whichever ones they have. They don't support every symbol, so I do throw a lot in there, and I have filters on. I want at least, I think my absolute minimum is 75 cents credit right now. I've had a little lower before. I just don't want to waste, I don't know. After slippage and all that, how it goes on these short-term trades. It's just not worth it. So a lot of stocks, and then the ones that are good for options, you can do. I wouldn't do long calls on them. I would do that more discretionary. It's all based on stocks, though. What's your recommendation for portfolio allocation per signal, trade signal? I'm going to add more stats so you can see drawdowns. I currently am very discretionary on like how, I don't want to, it's hard to use the word fundamental, but I look at the company and I look at the sector industry, and there are things that I overweight because of opinion, not back testing, not volatility, just how much I want to be in it. So I take the investor mindset as far as sizing, but I very much take the trader mindset as far as when I will own it and when I will be out. So like cryptos, I'm overweighted, and it's not because the volatility justifies it. It's because I think it can. I do not say it will. You know, people have a lot of fun, you know, with their big bold claims because the world forgives them for being wrong. So you can use big bold claims and everyone enjoys it and buys your newsletter and etc. But I just say that it can go up 10x and it can go down 1x. That's my opinion. So with that asymmetry in place, I want to trade it bigger. So that's what I think about that. I must have missed something. Are you using options? Thank you. Yes, thank you for clarifying all that. At present, most of these are going to be stock trades. If you use your options experience, I'm going to have options, uh, automated options trading and all of that in there. If it's a good liquid underlying, then the credit spreads are excellent. They're gonna take you from that lower win rate to that middle win rate, which is pleasant. That does smooth out the equity curve over time. You are going to give up on massive wins. And I'll tell you this too, do not roll your credit spreads up on momentum trades. Um, the gamma, you if it pulls halfway back, you can go back to a loss. So if the stock goes up 10%, you roll your trade up, it comes down 5 and takes an exit, you would have made money on the stock and you're going to lose money in credit spreads because the amount you made on the way up was limited and the way down had asymmetric risk. So do not roll them up. Just enjoy the higher win rate and the smoother return if you want to use credit spreads. And that's absolutely fine. I use them as well. Long calls, really make sure you know your exposure, your synthetic exposure, like how much of the stock are you controlling and are you comfortable with that? You're like, oh, it's just, you know, it's just a 75-cent option or it's just a $2 option. Who cares? You know? Yeah, but it's, you know, 100 times the stock times the number of contracts. Well, what's 100 times the stock price times the number? Would you buy that much of the stock? You know, like don't just go around and using leverage because you can. Make sure you're synthetically exposing what you're really comfortable with. On daily signals, it works. Short term, I wouldn't. There's too much trading for options. And what's the other? Almost any call is fine. It's like somewhere between 70 delta and 30. And from there, you're just going on risk reward. So if you go to 30, some of your trades are going to lose that would have broken even or made a little bit. If you go to 70, you're going to take some bigger hits, but you're going to have more pure exposure, more synthetically, just like your long stock. But all of the 70 to 30 is very effective for buying a call on rather than stock. What sectors? So that was, it's on here. So it's all, and it's not really, I wouldn't call them sectors. They're called themes. So all the stocks are grouped into themes. Some of them are in multiple themes, but these are kind of what I call next wave. So the things that have been changing the world and have the potential to keep changing the world. The stocks can come in and out. The stocks can come in and out of favor. But these are the ones that can have massive swings. I've narrowed it down to 89. That's what I'm using for this right now. Data centers, automation, battery tech, semiconductors. They're the ones that are down right now, or defense tech, space tourism. Those are the ones that are out of favor right now, wind, etc. Quantum's obviously having a great time. Not at the very moment, but been doing great. Is there a trigger on the NQ which you may or may not take the put credit spread trade strategy discussed earlier? So the one in that video, if you Google it, so put my name and then what was it? I'll just find the link here. Zero GTE options on and safer 2 was the keyword. Pause it before it gets noisy. All right, here we go. So this is the video. 0 DT options with more profit, safer too. I'm gonna grab the link. I can hear you. What is that? Oh no, that's my sound messing up. All right. So I just put that in the chat here. Checking my speakers. Yeah, that should be fine. Yes, and that went to everyone in I almost said Slack, in Zoom. So whoever can grab that can share that with whoever needs that. But now I'm going to come back and answer the question. I was looking for it, Bryce. Is in that tells you the signal. That one's no signal, actually. So the signal, I'm sorry, that's why you're asking me probably. I apologize for that. My favorite indicator, and I say favorite because it does pretty well on tons and tons and tons, like more stocks, ETFs, etc., turn out a decent result by and large compared to most other indicators on many, many different time frames. If you use the RSI crossing above 50. So that's another one. If you just put my name and RSI, you'll see some more videos on that. RSI crossing above 50, not used the standard way. So not the 80-20 or 70-30 or whatever it is. So I set the line to the up overbought oversold to 50, and when it crosses above 50 as a filter for long, below 50 short, or not short but flat. Now, low probability, right? That's going to be a 36, 39% win rate. Not of the time, right? Win rate. So if you say, oh, I'm going to go back and look, and you go back and say, no, it didn't work there, and it didn't work there, and it didn't work there, and then you just delete it off your screen, you may have rushed through that analysis. And if you just have me back or look for the videos, RSI plus is one, RSI. So that's what you want to look for. That's what I like. Hourly, not much faster than that. Brandon D. I know I've worked with a Brandon. I thought it was D. Have we worked together? Or am I thinking of somebody else? When a low win rate, high reward strategy outperforms its backtest, how do you distinguish normal variance from broken edge and know when to keep taking losses versus stop trading it? I'm trying to think if I've run into that. I probably don't look close enough. I just have so many stocks. I'm just underperforms. I think I said the word outperforms when you wrote underperforms. Okay, so now I'm going to be fully on track with you. Normal variance. It's just, there's not much normal in this world. It's like chop, chop, explosion. And then chop, 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 major explosion. So, yeah, it would have to, the volatility, I'm going to say the size of the losses is so thank you for patiently listening to me ramble and think about the answer. Now I have the answer for you. It's really going to be the size of the losses, and that, like, RGTI is a good example. It's so volatile that when you start seeing like big losses being taken, not in the equity curve, like individual trades, and you're looking at the chart, you're like, that was just kind of like within its normal price range, and the loss was a bigger hit than I wanted to take, and I don't really believe in this stock that much, so I don't want to take that big of a hit here. That'd say, oh, it's way more volatile than it used to be, or it just is more volatile than I realized. But when I pull them up before I put them on, I check the back test and I look for the max drawdown and say, am I good with that, or do I need to reduce the size? And I take the max drawdown that it's ever had in its history and say, how much do I really like this one? How much am I willing to take on that one? Yeah, I'm cutting this one in half, or it's Ethereum. I'm actually going to lean into it a bit. I'm good with it. You know, I'll take the bigger drawdown because I'm going for the bigger reward. If it comes and if it doesn't, whatever. And I'm not like a crypto, like crypto's going to the moon. Like it can also like lose 80% and never come back. And we'll say, remember crypto? Yeah. Everyone thought it was going to go up. That's right. Ha ha ha. Okay. That could happen too. And I'll be just fine because I'll be flat. If it's tanking and crashing, I'll be flat. But I think we're going to wrap it up. Um, got you some cool stuff. So as you sign up for that, you'll be on my list. More options stuff is coming. I do a lot of automated option stuff, a lot of stock options. Um, so that the more that's coming out, but this is the thing that I think options traders need, um, is some pure exposure to upside and the ability to go flat during a crash. And if you do that, you reallocate some of your negative gamma exposure, if that is what a lot of people are doing here, then you might have a smoother ride for the long term. All right. Is anyone going to unmute and wrap it up, or shall I do it? And you just chat in and let me know. What's it called in the formal meeting? You know, anyone make a motion to conclude the meeting? I just don't want to hang it up if there's another plan. Here comes a new message. Welcome. My pleasure. So yes, if you're signing up for the watch list, you'll be on my email list and I will communicate with you, and um, you'll learn some more stuff too. And I look forward to your feedback. Okay, got it. Thank you for letting me know. All right. See you later. Thank you. Bye-bye.